In this series of videos, we're going to be discussing depreciation of capital assets. Over the series of 3 videos, we're going to learn 3 amortization or depreciation methods. And I just noticed I used the word amortization and I used the word depreciation. I'm really referring to the same thing. We know that when a company buys a long-term asset, in the example we're going to do, this company is going to buy a truck, the asset loses value as time ticks on. If you think about, you bought a truck for $25,000, if you bought it in September, as we will in the question, by December 31st, that truck really isn't worth $25,000. We have to reduce the value of the truck because, we want our asset values on our balance sheet to match reality. And how do we do that? We amortize or depreciate our assets. And so, as I think I said, we're going to learn 3 methods of amortization. We're going to learn straight line method, and that'll be the focus of this video. Next video, we're going to be discussing units of production method, and I'll explain what that is at that time. And the final video, we're going to learn double declining balance method of amortizing assets. So with all of that preamble out of the way, let's just jump right into the question. We'll do straight line amortization, and let's see how we do. Tinker Inc. buys a new truck for $25,000 on September 1st, 2012. The truck is expected to be useful for 5 years, after which time the manager hopes to sell it for $5,000. The manager estimates the truck will be driven 300,000 kilometers during its 5-year life. The company has a December 31st fiscal year end. And it says, assuming the manager wishes to use straight line amortization, calculate amortization for each year of ownership of the truck. And what we're saying here is fiscal years. So let's go ahead and get to it. So a couple of quick concepts. We buy the truck for $25,000, and I think, okay, well, we're buying it for $25,000, and it's going to be amortized for 5 years, so $25,000 divided by 5. It's not a bad thought, except for this one key part. It says, after the 5 years, the manager thinks he's going to be able to sell the truck for $5,000. What that terminology is, and the technical term for what we are stating there, is the manager thinks the truck's going to have a residual value of $5,000. In other words, we're going to use the truck for the 5 years, and after the 5 years is up, he's going to sell it or trade it in, and he thinks he can get $5,000 out of it. So that changes the amortization equation a little bit. We bought a $25,000 truck, and that's the cost of the asset. We have a residual value of $5,000, and that means if I have a $25,000 asset, but I think I'm going to have $5,000 left over, I only want to amortize it for $20,000, and so we call that the amortizable cost. And we're just saying we only want to reduce the value of our asset by the amount we want to amortize, and that is $20,000. So I'm going to use this number as the basis for my amortization. Now, the reason we teach straight line first is because it's the easiest, and it is the easiest. It's dead simple. The math here is very straightforward. We have a $20,000 that we want to amortize off our asset. We want to do it over a 5-year period. So we just get an amortization rate, and it's a yearly amortization rate of $4,000 per year. So we're all set. We know we want to amortize this at a rate of $4,000 per year. Now let's look at our years. We've got the year 2012, and I just want to calculate the number of months we're going to own the thing in 2012. We're going to own this for, let's see, September. We'll start in September. So September, October, November, December. We're going to own it for 4 months of 2012. September, October, November, and December. 2013, we'll own it for a full year. Sorry about my writing there. 2014, it'll be a full year. 2015, it'll be a full year. 2016, it'll be a full year, and we're going to end up disposing of it if it all goes according to plan. And by the way, it never does go according to plan, but when we're setting it up, we're going to say, okay, if all goes according to plan, we're going to sell it on September 1st, 5 years from now, 2017. So we're going to own it for January, February, March, April, May, June, July, August. We won't count September. We're going to own it for 8 months. Now, this gets a little bit tricky. There's different rules, and a lot of times in practice, there's a rule called the half-year rule, where you, in the year of acquisition and the year of disposal, you only amortize for half a year. I encourage my students to go to the nearest month, so I get them to round to the nearest month. But your class might be different, or your approach might be different. But what we're doing here is absolutely not wrong to round to the nearest month, and so that's what we'll do in this example. Again, be cautious. You might be doing something different in your class or in your company. Okay, so in 2012, we're going to own this asset for 4 months, and we've said the amortization rate is $4,000 a year. So let's calculate our amortization under straight line for 2012. And the math is very easy. It would be $4,000 a year, but we're not dealing with a full year. We're dealing with 4/12 of a year. So 4,000 times 4/12. This is why I should do my calculations in advance. I'm just going to quickly calculate this on my iPhone. 4,000 times 4 divided by 12 is 1333. And I'm just going to round to the dollar here. So our amortization for the year 2012 is 1333. For 2013, we're going to take 4,000 times 12/12s, because it's 12 out of 12 months, so it's just 4,000. There's no real need to show a computation there. Same thing for 2014, it'll be 4,000. 2015, it'll be 4,000. 2016 will be 4,000. And 2017, we've got to go 4,000 times 8/12, and what you're going to find there is it's 2667. Now, what's important is when I'm setting up the amortization for this asset, I've said I'm going to amortize $20,000 from my asset over a 5-year period. Sure enough, September 2012 to September 2017 is a 5-year period. And now let's total up our planned amortization. Add it all up, and you get $20,000 amortized from your asset. So these numbers have to match. The fact that my amortizable cost is $20,000, and then when I've done straight line amortization, I've prepared a schedule for it. Yes, I've said I'm going to amortize $20,000 off the asset. Now I have reduced the value of my asset by $20,000. Now I want you to remember, as you're doing this, our journal entry for amortization, I'll just do the one for 2012, always is going to be the same. So on December 31st, 2012, my fiscal year end, I'm going to debit amortization, I'll just abbreviate here as amort expense, for $1333, and I'm going to credit accumulated amortization. I'm just going to put AA, but I want you to hear what I'm saying, accumulated amortization or accumulated depreciation, and I credit that for $1333. I just want you to not lose sight that that's what the journal entry is for amortization. In 2012, I would debit amortization expense, or pardon me, in 2013, I would debit amortization expense, credit accumulated amortization for $4,000, and again, that would happen at my fiscal year end. So, as you can see, straight line amortization is very straightforward, and the reason it's called straight line is if we have a full year of amortization, as we do in 2013, 2014, 2015, and 2016, when we have a full year of amortization, it's always the same. If I were to draw on a graph, it looks like a straight line. That's why straight line is called straight line amortization. Okay, in the next video, we'll talk units of production.